Ajay Saini is self-employed in web and app development. His earnings are comparable to his friends who are employed, but one thing that pinches him is that, like his friends, he doesn't have any investment in Provident Fund.
But Ajay has options. For the self-employed, there is a Public Provident Fund (PPF), which works just like EPF for the employed in the organized sector. The only difference is in EPF, the contribution gets deposited every month from the salary. But in PPF, you have to do it manually. PPF scheme is for 15 years. In this, government gives interest at regular interval. Any person can open a PPF account in a bank or a post office. Tax relief you get on investing in PPF makes this scheme more attractive. The importance of this scheme can be gauged from the fact that during COVID, investment in PPF increased rapidly. As per the RBI data, in 2019 and 20 September quarter, total inflow in PPF and pension fund was 1,09,961 crore rupees. In September quarter of current financial year, this increased to 1,21,831 crore rupees.
Now, question is, how is tax saved through PPF? PPF is a useful scheme from the tax point of view. This investment comes under EEE category. This means it is tax-free at 3 stages: investment, interest and redemption. Investment of up to Rs 1.5 lakh is tax exempt under Section 80C of IT Act. At the time of maturity, whole amount is tax-free. So, if you are self-employed, this scheme is good option for tax savings. Now, another thing is how much amount can you deposit? Under this scheme, in one financial year, minimum Rs 500 and maximum Rs 1.5 lakh can be deposited. Besides yourself, PPF can be opened for your wife and child below 18 years. In each account, you can deposit Rs 1.5 lakh, but you will get tax cut only on 1.5 lakh rupees. A working spouse can also claim the tax benefit.
Interest on PPF. The government calculates interest on PPF each quarter. Since April 2020, interest on investment is constant at 7.1%. During this time, interest on FD has fallen, but interest on PPF has remained above 7%. PPF has given a better return than bank FD. You get compound interest on PPF. If the opening balance of the account is Rs 10,000, then as per 7.1% rate, you will get Rs 710 as interest. This way, your balance will be Rs 10,710. Next interest will be calculated on this amount. As you increase your investment, your interest will also increase. Big amount from small savings. If Ajay invests 1 lakh rupees each year for 15 years, then after 15 years, his investment will be 15 lakh rupees. As per 7.1% interest rate, Ajay will get Rs 12,12,139 interest on this. This means on maturity, he will get Rs 27,12,139 rupees. This amount will be tax-free.
Now, for whom is it useful? PPF is a long-term investment for 15 years. In times of crisis, you can withdraw the funds partially. Financial experts consider it to be a safe investment, but during this inflationary environment, it doesn't provide sufficient interest because there is a risk of fall in its interest rate. If you don't have high risk appetite, then PPF is the right investment option. The 15-year lock-in period in PPF ensures that people don't use this for small expenses. PPF is a good option to prepare a retirement fund. This gives a better return than bank FD. You save your money for retirement and you get an attractive return on investment without any risk. You must have all kinds of investment in your portfolio. If you don't have long-term investment assets in your portfolio, then add PPF.